What if I told you that you could do an interview with a billionaire and only get straight up answers? No bullshit, no fluff, keep it real 100. Imagine you have some truth serum, right? You inject it to this billionaire and he has to give you straight up answers for 48 minutes. Well, that is literally what happened minus the truth serum with Chamath on Bloomberg. 48 minutes of honesty. He talked about everything we want to know. SPACs, Robinhood, the GameStop controversy, Tesla being overvalued, short selling in general, so many gems. And at the end of this video, I'm going to give you a link to the full interview. I highly recommend you actually watch it because it was phenomenal. But just to get you started, just to get the appetite going, I'm going to give you some of the highlights from the interview and my own opinion about it if you want to hear it. By the way, this is exactly what it is. It's just my opinion. So it might be inaccurate, might be wrong, might be the ramblings of a madman. Who the hell knows? I highly suggest that you do your own research, find out the truth for yourself, allegedly, blah, blah, mother effing, blah. Now, let's get started. So first of all, let me play you the first clip, which is about short selling. Basically, Chamath was asked, what does he think about short selling given what happened with GameStop and the support that he showed for Wall Street bets and the retail investors? And this is exactly what he had to say.
In terms of short selling, I buy the fact that it's an important part of the market. I'm not a huge fan of it. I do think that certain folks really use it to run a neutral strategy. And, I think that that's great. But I also think that, now in the world of social media, and we've seen this recently, disinformation can be used to not just cause political damage, but I think disinformation can also cause economic damage.
Well, in this case, if you expected Chamath to follow Elon Musk and say, I think short selling inherently is bad, you were disappointed. Because that's not what he said. He actually said something really smart, which I agree with, and I'm on record saying it in previous videos. You can go and check me. He's basically saying not all short sellers are bad. I don't think it's efficient the way it works right now, but not every short seller is inherently evil. What he's talking about, and I'm paraphrasing here, is cases like Wirecard, a company from Germany of all places. Can't think of a German fraudster in my life, but Wirecard was a fraud, and the people who brought it down were short sellers. Same thing with Hindenburg Research, who I actually like, and a good friend of mine who brought down Nikola. There's plenty of good example of good short selling exposing frauds and exposing people who are actually not saying the truth. However, there's a lot of inefficiencies, and that is why he's saying it's not optimal. Because a lot of rich people, a lot of billionaires can utilize the system to manipulate the market, to bring down share prices to the bottom unfairly, and when it's completely not correlated with the actual value of the company, just so they can make a quick buck on the short sale. And that is inefficient. That is suboptimal. We don't want that in the market. So what he's saying here, we need to find a better way to regulate short selling so we can keep the good ones and weed out the hedge funds that are doing this shit. And at the risk of alienating a lot of you, because I know a lot of you will not agree with me, I agree with Chamath. I don't think short selling as a general principle should be illegal. I don't think it's inherently evil. I think people abuse it and people mismanage it, and there's bad actors that need to be regulated, but short selling in itself can lead to positive results, such as Wirecard, such as Nikola. But in this case, we might agree to disagree, and that is fine. You don't have to agree with every single thing I say. I'm not a dictator. Number two, let's talk about Robinhood. Now, if you remember in my video, I told you what's going to happen with Robinhood. I told you mainstream media is going to throw it under the bus as a casualty of war against the retail investors. Watch what happens.
One of the things the GameStop episode, let's call it, shone a light on is Robinhood. And not just Robinhood as a company, but zero commission trades and the ability for retail, let's call them retail investors, to participate in a momentum chase. Do you think on balance that apps like Robinhood and the way that they've gamified, and you've heard that term many times, trading, not investing, but trading, is a healthy thing on balance?
I think that it should be allowed to exist. You use the word healthy. I think it's healthy? Not particularly, because I think it keeps people in this ghetto of being labor. I started as a day trader, effectively, meaning on the side, I would speculate in my teens and in my 20s. An investor is not a speculator, and it's not a day trader. And I think that a lot of retail, a lot of normal people, the only way they will close the inequality gap is because they take it upon themselves to learn how to become an investor. The government's not going to save them. No law is going to save them. No, taxation of the rich is going to save them. they can save themselves.
Well, that was a really interesting clip. You saw the Bloomberg guy was trying to throw Robinhood out of the bus. They're trying to go at these retail investors by using Robinhood. Essentially, Chamath swerves all the way to this matrix-like swerve, escapes this horrible question, and answers with a different answer to a question he wasn't asked but was really important to say. He basically said, hey, I think in general, people who day trade, who are not professional day traders, is not healthy. I think people should gravitate more towards, hey, long-term investing, value investing. Look at my video from a few days ago. This is exactly what I told you. Chamath and I agree. Rather, I agree with Chamath. That's the proper order. I mean, he's a billionaire and I live in my mama's basement. I mean, not really. But I mean, it's not the same level. Come on. Unless you can bring me to $1 billion, I don't think so. But hey, I'm happy where I'm at. And now watch the next clip where he gets asked a very tricky question. What about fundamentals in investing? Do fundamentals even matter? It's a question I get a lot in my comment section. Well, Tom, prices are going through the roof. Liquidity is crazy. Do fundamentals even matter anymore? It's a really good question, and I like his answer a lot, but it's a little bit tricky. Check it out.
I want to understand, Chamath, how you decide what to invest in. Do you believe, and this is a subject that's come up on your podcast, your All In podcast, do you believe in fundamentals? Or as has been argued, a stock can trade wherever, regardless of whether it is or isn't hinged, to the fundamentals of the underlying business?
Well, maybe I can just give you an insight into how I process any opportunity.
Sure.
Random company comes in to the top of the funnel. Immediately, I'm making a very quick, hopefully it's a decision, but maybe sometimes it's a judgment. And I'm asking myself, does this fit into my worldview or not? Meaning, is it in my circle of confidence? And I have a very simple way of looking at this. Is it going to fix something in inequality that I think is important, or is it going to fix something in climate change that I think is important? Those are the only two things I care about. Inequality and climate change. Under inequality, there's a bunch of stuff. Financial equality is important. Healthcare equality is important. Education equality is important. So it allows me to organize a lot of different opportunities. And I'm trying to figure out, is there a consumer proposition here that's important for them? Does it make something more symmetric? Does it take something that was asymmetric and fix it? So that's my first judgment, which is qualitative. That's why whenever I start my one-pagers, it's always, what is the strategy? And you can read all of these one-pagers now. And what you'll get away from them is the first lens is equality and or climate change. Then I start to do the fundamental work. And this is where I have a real issue with a lot of people who say that they're value investors. I think that I'm a value investor. The thing is that when you look up the word value in the dictionary, it doesn't mean cheap. It doesn't mean a cigar butt with 2 puffs left, that famous Buffett Munger quote. I think it actually means something that has value. And so then I'm really thinking about, what are the cash flows of this business? How does it create a moat, right? Meaning in software, some technological way that's hard for people to compete with it. And then can I get it for a price where there's a margin of safety?
So you just saw Chamath answer that brilliantly. And let me explain to you what happened here, because this was really interesting. He started off talking about value, about positive change, about disruptiveness, about really important values he believes in as being the guide for his investments. And that is fine. But watch what he said at the end of the clip, where he was talking about cash flow, business model, about runway, about burn rates, every single thing we're talking about. So basically he was saying, well, if the investment meets my threshold, my moral value, hey, remember my system? Then I'm going to take a look at the cash flow, the business, the fundamentals, the management, pretty much the same system that I use, my 5-step plan. He's using the same thing. Remember my Dexcom video? I was talking about the moral aspect of it. I love this dude. And the next clip you should have anticipated if you ever watch Bloomberg in your life. I mean, they always push this anti-Tesla agenda. Tesla is overvalued. Sometimes they'll ask the question. More times than often, they'll answer it themselves. It's a propaganda machine against Tesla. And of course, they pose the same question to Chamath to put him in an uncomfortable place. But obviously, they haven't watched a single interview the man did on CNBC because his answer was killer. Let me show you.
So let's use a real world example. Obviously, this is not the kind of deal you're doing. But if you looked at Tesla today through that lens, is that stock a buy with a market cap north of $800 billion?
The short answer is yes. The reason is that I think it took people, look, I bought Tesla in 2014 or 15. I was one of the largest owners of the convertible debt. I felt that was the best margin of safety way to bet on Tesla. It's turned out to be an enormous winner. And I really believe in what Elon is doing. I think he's the most important entrepreneur of our lifetime right now. It's taken people 15 years to embrace that they're going to be now a legitimate car company. But when I underwrote the investment, my bet was on something bigger. And I think that Elon is well past building a car company. And I think it'll take another 5 or 10 years for people to figure out what this next arc of innovation is. And what that is the deregulation of energy. If you look under the hood, utilities spend tens of billions of dollars, hundreds of billions of dollars a year all around the world on CapEx. They are completely regulated. They feel completely safe. They feel like they can issue debt ad nauseum. They can cause all kinds of damage to the environment or otherwise. Look at PG&E and still come away unscathed because they're protected. Except that something is happening that nobody forecasted, which is the complete bottoms-up disruption of energy.
And of course, I couldn't agree more. Tesla is a 1.5 trillion company. I said it when the share price was 400. Half, Eddie, half of what it is today, and people were laughing at me. I told you, it's going to go to 1.5 trillion. So literally, I believe there's 100% more to have in Tesla, but this is just my opinion. This is not investment advice, just for entertainment. My opinion might be wrong, but I'm saying I agree with Chamath here. We haven't even seen the surface of this thing. Tesla is going to be much more than a car company, and if you don't realize that, you're lagging behind. I suggest that you actually do some research about what they're doing in energy, decentralized energy, storage solutions, all of this stuff. Go read it, do your own research for yourself, and find out your truth, allegedly, blah, blah, mother effing blah. Anyways, let's move on, and let's talk about SPACs. In this clip, he got asked what does he think about SPACs, and his answer was really interesting. Again, check it out.
Chamath, you've built an extraordinary franchise in special purpose acquisition companies. 6 SPACs, billions of dollars raised so far. Tell me, from your perspective, is there a limit? Is there a limit to what you can do with SPACs? Is there a limit to the size of the SPAC revolution in terms of available capital or quality of targets?
I think what's happening in SPACs is really about the dismantling of the traditional capital markets with respect to fundraising. So the equity capital markets, really had one go-to move, which was the IPO. And then obviously there was follow-on financings and all of that other stuff, but the traditional S1-driven IPO process. And what you picked was a brand that you trusted to be your on-ramp into the public markets. You pick Goldman, you pick Morgan Stanley, you pick JP Morgan, Credit Suisse, Barclays, etc. I think in 2021 and going forward, you're still picking brands, but that choice has become more atomized. And instead, you'll pick the IPO 2.0 platform that myself and Ian Osborne created. You'll pick, the reInvent platform that Reid Hoffman and Mark Pincus has stood up. You'll pick, the SPAC platform that Alec Gores has created. And there's many different versions of this. But that is the exact same decision that used to happen 25 years ago when you used to pick a banker. Except now you're picking an individual level partner. And so I think that SPACs are very much here to stay. Back in the, using the language of inequality, it evens the playing field. It democratizes access to high growth companies. How? Because it allows retail and it allows long tail institutional investors, folks that may not have necessarily been tier one hedge funds. Now they can also play. They may get allocation in the original SPAC IPO. They can go buy in the market as soon as it goes public. They can participate in the pipe. They can buy after a deal is announced. So many opportunities versus one allocation in a book building process that a traditional S1 process was all about.
What's the biggest SPAC you can see yourself raising?
Having a bigger size doesn't necessarily help. In fact, what's more useful is to actually have a reasonable size because you can upsize a deal with a pipe and instead focus on sectors and themes. And the reason is because, again, going back to brands, entrepreneurs want to partner with people that deeply understand your business. And so it's much more likely that if you had 2 or 3 SPACs, all of the same size, except with sector focuses, you could find different independent directors that were subject matter experts. That'll make the companies better. It'll make the diligence process more useful. The decisions are higher quality. And so I think that's where the world should go. But I'll tell you, putting a $400 million SPAC to work is meaningfully easier than a $1 billion SPAC. And I've done both, but the former is much more flexible than the latter.
And let me surprise you in this clip. You probably expect me to agree with Chamath because you know I like the guy and I pretty much agree with everything he said so far. So you probably expect me to agree with what he just said. And I agree. There's no surprises here. I agree. So he's talking about SPACs being a solution to a problem. Problem being that IPOs have gotten so fat, so lazy, so expensive that a company going through the ringer of an IPO, probably it's going to be so cost inefficient. It's going to take ages. Who knows? And it's an oligopoly. There's only so much underwriters you can use to go public. So it's a very closed market. It's very problematic. If you want to get to public money fast, SPACs is the way to go. That's what he's saying. But obviously, he isn't running away from the issues. SPACs have led to a lot of bullshit. Nicola, there's more examples about SPACs. I mean, SPACs are not perfect. Because of the speed, because of the ramp up, it's not as regulated and as scrutinized as an IPO. So you're going to have a lot more bad actors slip through the cracks. It is what it is. So if a company chooses a SPAC, you have to acknowledge the fact that it isn't as scrutinized as an IPO. You should know that. Now, the other thing he gets asked about is really interesting. Check it out.
You describe finance often as a game rigged in favor of insiders at the expense of outsiders, especially the retail investor, the little guy, if you will. But I would make the following observations, and others have as well, about SPACs. The sponsor gets a 20% promote. Wall Street banks get paid underwriting fees twice. Hedge funds get big share allocations and then cash in the warrants to make a risk-free return. And finally, giant investors like Fidelity, BlackRock, Neuberger Berman, and well-connected billionaires like yourself get to participate in pipe transactions at $10 a share, right? The same price as the retail investor, but with total information. How is that not a giveaway to insiders at the expense of outsiders?
Yeah, I think this is a really good point you're making. So let me break down a few of these points. Look, the first is that if you can generate superior returns, you should be allowed to compensate and participate yourself in that. When I used to manage institutional money, again, all of this capital is my own, but when I used to manage institutional capital in early stage investing, I charged a 30% carry. No hurdle, no nothing. And people were willing to bet that I could generate returns, and I have, 30+% returns over the last decade, that justified a 30% carry. Similarly here on the deals that I do, I take a 20% carry. And I think that I can find targets and find opportunities that will make that more than reasonable in the final analysis. And I think that if you look at the returns we've generated for shareholders, it's been nothing short of incredible, inclusive of the carry that I've taken.
So in this case, the interviewer is trying to put him on the spot, basically say, well, do you deserve access to private information before everybody else? Well, you get it for $10. We'll buy it probably at 15. That's not fair. And Chamath is honest. He's just saying, well, I'm worth it, motherfucker. I agree with him. He is. If you don't think he is, don't invest. And by the way, I do suggest and recommend you watch the full interview. 48 minutes of straight up gold. He talked about a lot more issues than we covered in this little highlight. Go watch it. The link is going to be below. And by the way, before we check out, a huge thanks to our channel members, our Patreons for making this possible. You guys are awesome. Thank you so much. I appreciate every single one of you from the bottom of my heart. You guys are the best community on YouTube. Thank you so much. We'll see you guys in the next video.